But let's find out if our properties are getting older. Does that mean it's a good time to sell? What if we're considering purchasing a property? Do we want to purchase something older that's more inexpensive and affordable, especially when we can see that new builds sometimes are, if it's fourplex, above 1 million, whereas an older one is below 1 million. What do the numbers tell us makes more sense and dollars to own? An older property or a newer property? Tony is going to share his personal story. He has a case study where he knows what he was wanting to do and what his instincts were telling him. But for this presentation, it's gotten him to delve into all the data and go, what are the numbers actually saying? Do they mirror what I want to do? And for those who don't know Tony in the room, he founded First Rate Property Management Company way back in the day. So he's seen thousands of rentals and what goes on with them, everything that could ever happen to a house or to a unit or to a furnace or to anything like that. And he's an associate broker at Swope Investment Properties, top producer in the brokerage, alongside Mike for many years, and is a race car driver. Tony Drost, let us know how it turns out. I present you Tony Drost.
All right, well, this is where the presentation goes downhill. I'm not a presenter, but I know the investment properties, and I'm going to just we're just going to have a discussion. We're going to do a little case study. We're going to talk about these things. And I guess, when Stacy and when I was telling her what I wanted to do, she's like, oh, that's a great idea. And we should present it at AVID, because maybe some of you are all kind of going through this same thought process. So I own a number of rentals. They're getting older. I don't know, anybody else notice the cost of maintenance going way up? Turnover costs are just terrible. Like I don't want to do a turnover. It costs too darn much. And then as my stuff's getting older, I've got these capital expenses and performance-wise, NOI is acceptable, good, because the rents have increased so much from the time I've owned it. But my cash flow sometimes hasn't improved because I'm replacing furnaces. So I had the fourplex that we're actually going to be looking at that I own. I had to replace 2 full HVAC systems this year, and they were like $11,000 each. So, boom, 22 grand. I'm like, well, that's gonna suck. And the year before I did, because they're older, 93, we were doing some remodeling to open them up. All new stuff has these open floor plans, and in 93 they weren't open, and that remodeling was costing me 15 to 20 grand per unit. And again, so there went the cash flow because I'm spending money. So we were talking about it, and Stacy thought it would be a good idea, and I'm gonna go through it. If anybody is going through the same thought process, has input, let's try to go over that. And is somebody monitoring the online folks, like if something comes up? Because if I'm monitoring it, I'm not paying attention. I don't know. So here's our overview. We're going to compare fourplex performance, old versus new. Stacy kind of showed that new fourplex is up there for 1.275, but there was another one that sold, and I chose not to use it. I used a 2015 instead because I dislike those fourplexes so much. They're built by this out-of-state builder. I've walked them. Quality is not real good, and not only is the management, they're from Salt Lake, but they're not on site. They're in Salt Lake. So if you want to show the property, like I had to get my credit card out, and I go in here and I use this lockbox and I enter all this information, and insert a urine sample in there to get into things. And that's how it's self-showing. I didn't like that. There's a lot of things that I didn't like, and then they're amenity filled. They have the tech package and all this. Well, your HOA dues are $700 and some a month. So that's killing performance right there. So I I didn't do that one. So I did cover that.
Brian, can you tell us what area that is?
That ski jump, that the listing that Stacy just had. And I think that's the one that's right behind, off of Eagle Road, behind the Fast Eddies. This might be a different location than that one, but I think that's where it's at. That's the ones I walked. Same builder, same product. Like, I'm not kidding you, the powder bath. So there's 3 levels. And the powder bath, okay, kind of think of the sink that you have when you use the restroom in the airplane. That's what you get. But you don't have to do like this. They use they fix that part, but everything else is identical to the bathroom in the airplane. Yeah, it wasn't good, right? We can get you exact, we can pull you that one if you really want to.
I'm just curious.
Hurt yourself. So I want to talk about the obstacles. So inventory, Stacy goes over that inventory all the time, but it's Ada County and Cannon County. Ada County has been low. I mean, and I think that's why the fourplex values have stayed as well as they have, is because they're just not a lot out there. Funds, we're going to talk about funds, and Ty, you might have some good ideas there that I haven't added. And timing. That's the hardest thing. So let's say I want to sell my 93 fourplex, and I know that I can get, 935 grand. I sell it. Now I got 45 days to identify a property. Well, they're just not coming on the market that quick. And what does come on the market maybe is this ski jump thing that I can't stand and I don't want. And then that's how a lot of these people get in these exchanges, is they feel stuck, right? And so they take what they can and then they regret it. Well, I don't want to regret it. So we're going to talk about a reverse exchange, which I've done. To me, it makes a lot more sense. There's a lot more moving parts. It's more expensive, not quite as easy as it is. Maybe I just got lucky that I didn't screw it up where the IRS didn't catch me. I don't know which. And then, yeah, if we're going to do a reverse exchange, we talk about the source of funds. So personal goals. So I own a number of properties and they're driving me nuts. It takes me, I have my processes. I can't, Stacy's always saying, why are you going through all those motions? It takes a lot of time. It's just my process. And it takes me about a week to go through all of my property statements. And then at tax time, I have 16 LLCs that I'm putting in. So I'm sitting here waiting for all these 1098s, 1099s, all these forms, which it seems like the government's allowed more and more time. Yet I got to get it to my accountant so that they can go through them all and then get it in on time by March 15th. And I am a cranky son of a gun in February and March. I mean, it's a lot of stuff to gather up. And maybe I'm not all that as organized as I thought, because it just seems like it's a pain in the butt. So one of the things I'm looking at is consolidating. I'm very diversified, which is probably good, right? I'm in all kinds of different areas. So am I making a mistake at looking at consolidation? But, for me, I'd like to sell all of fourplexes and just buy a newer apartment, smaller apartment building. Finding one's a little harder. So what do I got here? I'm gonna have to put these on. Yeah, so we already talked about the large capital expenses. I said HVAC, roofs, 93, guess what? Roof, and the remodels. I mean, if you want to maximize your rents, and we're going to see that in my case study, because I have maximized the rents in my property. In fact, my rents aren't that much different than the new property that I'm comparing it to. That's how well I've done with it. But it's coming at an expense, and that expense, hurts the cash flow. Performance has been great. Cash flow, not so much because of the capital improvements. And then the fourplex communities and these older places are aging too. And guess what? They're having problems. Like, for example, the parking lot drainage. I just thought water went into this drain and it went, I don't know where it went, it just went, right? Well, no, it's a dry bed. And those things have a life of about 30 years and it's done. It's filled up with debris or what have you. And that's where they're getting bids now, but 30-40 grand. And the HOA has about $12,000 in reserves. So guess what? The dues are going up. And there's gonna be some special assessments to cover it. So again, we have all these things, everything, I've done everything I can on the property, but there's these outside forces that are killing performance. And so what's the benefits to newer? Well, you get the builder warranty, right? Reduced maintenance needs. You're not gonna have any capital replacements. You know, it takes time. Like especially if it's like I'm always going to the property. When the property manager calls me and says, we got a problem, I mean, if it's a big problem, I want to go look at it. One, in my opinion, they may just choose the easiest way to solve the problem. I want to find maybe the more cost-effective way of solving it. When we were talking on the phone, we were talking about the window AC, you know, where an HVAC guy charges $2 grand, where, you know, a handyman could go to Home Depot, buy the same darn thing and put it in there for $600. It was way easier to call the HVAC guy to do it. It wasn't most cost effective. So I like to put my eyes on it. And so that all takes time and trying to reduce time. I think, we already go over that? Yeah, I want to save time, right? I want to reduce all that, and lower maintenance is going to help. Yeah, so consolidation. Okay, so every month I got all these statements, it takes me all this time. And then the tax, we talked about the tax returns. Am I speaking the language of anybody else? Anybody else sitting here looking at these same things going, what do I do? Okay, you got a few. Well, after this presentation, I have good news for you. You're still not going to have the answer. Oh, okay, so let's look. New construction, fourplexes. There's been one since 2021. Now, if you're getting MLS listings from me or StacyA or whatever, you have seen more than just one new fourplex listing. But guess what? Those didn't sell us a new fourplex. They ended up on some of these developments where they built all these fourplexes. The developer wanted to sell them all at the same time, and so they listed them as fourplexes, but then they also listed them as apartments, and they sold as apartments. They went away, you know, and that was large complexes, so we're talking a lot of money. One of them was Star Eagle. I don't know if anybody saw those. I looked at them, and I don't know, when they were being built, and you know, we were kind of seeing some things change. I kind of felt, I mean, even though development is going that way, I just thought if things got tough, I mean, it seems like when things get tougher, like the closer you are to the city, the safer you are. If I got a bunch of fourplexes out, an Eagle with a stone throw away to Star, it seemed like that was a little too far out. So that was past my comfort zone. But anyway, it wasn't a fourplex anyway. So there's been one new fourplex since 2021. And then Canyon County, they're higher numbers. I went to the triplexes, kind of the same thing. And boy, I'll tell you, the triplexes that were listed were some pretty high end, really cool stuff. And really what they were townhomes, single parcel that were built in a combination of three. Excellent location, excellent rents. But performance wasn't real good anyway. So anyway, kind of show you the numbers. And I mean, if you're like me and you're looking at Ada County, there's not a lot of options. So for me to sell and to try to do an exchange, I'm like, there's zero comfort in that I can do that. And I'm guessing you guys are probably feeling the same. All right. Property on the left is my fourplex that I bought. right after the housing crash, bought it well. And, it's performing well. I mean, the rents are doing great. And then on the picture of the other fourplex, that's 2015 build, that's kind of like the Pine that I told you about, the whistle stop. That's the same design, different location, and actually a West Boise location. And, and I explained why I didn't use that ski jump one, because of all those reasons that we already went over. All right, are you guys able to read all of that? Because I'm not.
Well, they have it printed out
Okay,
and you have it printed out.
so I mean, so it
But on
seems,
front and back,
really feasible. So if you look, you'll see one that says 4900 West Blodgett, and then you'll see one that says 6731 Pole Haven, right? So the 4900 Blodgett is the 93 that I own, and I feel confident I could sell it for 935 grand. When I look at Pole Haven at $1 million, I mean, it was listed for less, it went a little over, but basically at $1 million. I mean, the delta between 22 years doesn't seem like a lot. And it seems like I ought to be able to sell one and get the other one and be better off. So we ran the numbers and, yes, ma'am. Yeah, if you look at, if you just want to jump to NOI, Blodgett at 45 grand a year versus 50. It's not the numbers I remember, but that's what it's saying. Oh, no, I'm so sorry. Yeah, let's just drop down to net cash flow. You're at 36 at Blodgett, and then my net cash flow drops to 23. Why did that happen? Because I have to replace my debt. I got closing costs. I sell the one property. I got my closing costs. I take the net, and then I look at the percentage of my debt service, which was at a low rate, low number, but percentage wise, then I increase it. And at the newer rate, my PITI is higher and it's affecting my cash flow. But so even if you look at the 23 versus the 36, take away my capital expenses, those big, like, $20,000 in just HVAC this year, maybe the cash flow, maybe what I'm putting in my pockets, no different on year one, and hopefully improve going forward. At any rate, those numbers aren't super compelling to me. I don't know if anybody else looks at these and says, and thinks differently. But to me, doesn't seem worth it unless I just want to go through the motions and work up some production and make Mike Swope happy. I might.
so Tony, you're saying that the 1993 property is making 36 grand a year. And you're saying that the 2015 property costs $100,000 more or so, and it's making 23 grand a year.
Yeah, because my debt service percentage, so I'm carrying more debt on the second one at a higher rate.
So does this mean that you kept some cash out of the deal going from one to the other?
No, I didn't. And I don't know where I got the numbers, but what I did was I worked up a net sheet from the sale of the Blodgett, and then I took the percentage of my debt service and then just applied it and try to keep it equal or greater.
You're going from 4.25% interest.
Yeah, that hurt.
That's the difference, right?
Yes, sir. Yeah. So, like I said, in this situation, it's not really giving me, it doesn't look like a worthwhile endeavor. Even though that delta between the newer and mine is so minimal, in my opinion. I mean, and I was expecting different results, but I didn't think about the difference in the debt service. And it wasn't until I put these numbers in here, I was like, ouch. Yeah. There's some difference in the management fees. I gotta have a good management fee, but it's like I know somebody around here. But the other one, the new one is at 4.5, but that's all smoke and mirrors, because trust me, anybody's charged 4.5% rate. There is some fees coming elsewhere. They're gonna make it up. You can't manage, when I owned first rate, we ran stats. And I did a lot of different metrics. That's just how I do things, and I like to look at it, and I knew exactly what our break-even point was. And it was just below 5% at that time. So anybody charging 4.5 is losing money so that they can make the money somewhere else. Unless they've got some other way of doing it. I have no idea. Any questions to this date? Are you guys questioning me on the management? They're like, what the heck? Yeah,
What are you cooking up, Walt?
We're just starting to talk something to say.
okay. And we want to go over? No, okay.
Just compare.
Yeah, all right. So here's the performance numbers. Mine blocked. But is the
23.
GRMs identical?
168 versus yep, identical GRM.
Yeah. So my cash on cash return. So what the Blodgett's got a better cash on cash return. I
That's
mean,
the new one. Is that the new one?
no, I don't think
The old
so.
one.
Yeah, my screen doesn't show which one's which, but
Oh, yeah, Blodgett's the 36. Yeah, the old one.
anyway. To me, it's not a worthwhile endeavor. I think everybody's agreeing.
Yeah.
If you're doing financing.
Yeah, right,
Sure.
right, cash, good. See, that's why we keep her around.
I thought it was the beer.
I don't have a beer. Yes, unless it's cash. I should have ran this with cash, but my situation wasn't that.
But I mean,
Yeah,
Yeah, you just made it 8 cents.
yeah.
That's 515, I think it was, isn't it?
Well, what would it be today, Ty? Assuming that I'm, 800 plus and that's very low loan to value.
We have a portfolio right now that's 7.75, but it's a 4.5 cost.
Okay.
But that's today's.
yeah, that's the new one.
Yeah,
because-
so I mean, if I sold my Blodgett today, I'm gonna
Oh,
have to get a loan today. Yes,
yeah,
ma'am.
that would be trading in the older for the newer. So the older one has the low rate for something, and then the new one is. So this study is showing what happens if you trade in the older model for a newer one, and what we're finding is the interest rates are not making it worth it.
Right.
But if you're gonna do all cash, that would be a big game changer. We just know that because your expenses are so different.
Yeah, where you gonna get cash from the first property, then you gotta pay capital gains.
You do it in change.
Say that again?
So I'm just wondering.
Yeah.
How do you do the all cash?
Oh, well, okay, so I've done that. Let's see. Oh. Let me go through this and then we're gonna talk about that, and my guess is Ty's gonna have a few more suggestions. All right, so I told Stacy, she's like, we had this discussion, right? She's like, oh, we should talk about that at AVID. And I was like, well, she goes, well, what's your number say? And I said, I actually haven't ran the scenario. She's like, well, run it, let's go. So I run it and I said, hey, you haven't told everybody what the topic is yet, because that was a big fail. And she's like, no, it's all good. We're all learning together. It's great. And we want to talk about the single family. So gosh, the inventory levels have been pretty low on fourplexes. So the last few years, up until recently, single family rental prices have gone up. And for the first time in a long time, single family rentals were actually outperforming a fourplex because of the price point and the rents you could get. That I think in here I talked how that has softened. Yeah, so they started softening about mid 2022, just right before Stacy and I closed on our single family home that we bought. So what we did was we looked at, and so we had these two performas. And what we have is our projected. So when this came out, we're like, holy cow. 4 bedrooms, right? Or yeah, 4 bedrooms for 400 grand. Oh my goodness. That is gonna be a cash flow mama. And because the 4 bedrooms, rents by bedroom count just improve. So we did our due diligence. So the range that we got was 22.95 to 26.95. At some point, somebody said maybe 27.95, and my guess is that was probably March, April, right before things slowed down a little bit. And so we built this pro forma, which, was showing us 22 grand in cash flow. And our cap rate was a 5.42 on a single family. There was no fourplexes selling in the 5s. I mean, so this was a slam dunk. So we bought it. And now I have the actuals.
And you bought it cash, so you dodged the interest rate concern.
Yeah. But I mean, our cash flow is, 8 grand less than what was expected. We had a little bit higher vacancy. We had to close, the builder we had a 1031 exchange deadline. So we had to close, they weren't done. So we owned a building that we couldn't rent for a little while. And then we started getting into the fall. Fall's not a good time to rent single family. All rentals kind of follow in this area, a little cycle. Once school starts, things start slowing down, and we started getting into that thing. And so the rent came down, the vacancy extended. At any rate, this kind of just shows you what the real performance is at a cap rate of 3.56, which isn't as impressive.
And that's when the rents started coming down.
Yep, exactly. And they're still softening. So I bought 3 more of these townhomes. Not in this location, but another location that were only 3 bedrooms. And there we were projecting 22 to 24, 21 to 24, and we came in, they didn't get done until November.
Oh,
Not a good time to try to rent out. So I rented those darn things out at $17.50. So they're real snoozers so far. Bummer deal.
That's year one.
Yeah.
Way longer than.
Yeah.
because you had 25% vacancy in there, which is what we endured for year 1.
Yep, that's
which is
exactly what we
killed
did.
The numbers.
Yep.
So that also goes to show that vacancy is the big number killer.
Yeah, I mean, your vacancy is gonna be 25. We just had some bad time here. And then my ones again, new construction, you can't necessarily always control the completion date. And, fall, winter is not a good completion date when you want to try to rent the darn thing out. So remember that.
By year 10, you might be a little happier with investments.
We'll see
Then
how
it'll
it
be an
goes.
old investment.
Do you think there would have been any wiggle room with the very few multifamily units selling, or the owners who have carried 20% of that or something, so that your cash flow numbers are very different for a couple of years?
Let's create. Yeah. It's been a long time since I've gotten into the owner carry game. So I'd have to re-educate, but yeah, and that started coming back, as of recently. It seems like people kind of forgot. I don't know what's going on right now. I don't know why the craze has happened. I mean, it's not the rates went down. I think people just, is that what you think, Ty? They just accepted it and said, here we are, let's go.
Yeah, I think people finally figured out that it might not ever be back down to one. Started buying again.
And they didn't increase them this last time, but what do we do? Like, I heard that there's some lenders that are recommending not locking.
Yeah, I mean, I think they're still planning on raising them
another half, probably by the end of the year. But it shouldn't actually affect mortgage rates. Mortgage rates should actually drop a little bit.
Okay. Excellent. All right, so we went over the single family, like I said, those were doing well, and then we saw some rent soften up. Not as well. It's amazing how things keep moving, you know, in 2004, 2005, when things went crazy here, the fourplex values just shot up. But for whatever reason, you know, the large multifamily was not. And I think it was because, you know, the fourplexes were obtainable. And I think that the people who were investing from mostly California were doing like HELOCs on their homes, buying them and getting in this investment property. It was easy. And so they did. And the larger complexes weren't being touched because I guess we weren't quite as famous as we are now. So then, you know, so the move there was to get out of the fourplexes into the apartments, which we did. I did that with Mike on a lot of them. Good move. But today, you know, the apartments, even though the examples that Stacy have, don't show it, those aren't. I think that's more indicative to the two properties than where we're at with apartment buildings. Like, it's hard to get an apartment building, and it's hard to get an apartment building that's gonna perform very well. Because the prices have gone up so much.
That would be just specific to here.
Probably, yeah. I don't pay much attention to elsewhere, but yeah, I mean. The last one I sold was like a 3.5 cap. Kind of boring.
Some of the other parts.
Yeah,
Oh, yeah.
We got 2 areas states, right?
Yes, ma'am.
Don't laugh at me, but I'm a novice at this. Is there any anticipation at all that prices will go down?
No. You know, I follow that data when it crashed last time. Like, I mean, I didn't know, but I was like, I took my data to Mike and I said, well, do you see what's going on with this trend analysis? And he's like, yeah, and I mean, I wasn't, but too much longer. Yep, there you go. And that's when I started actually doing it. So I used to just create the data as needed. And when that all happened, then I was like, well, and I kept referring to it. I'm like, well, you know, why do I keep creating this data and remaking a new spreadsheet every time I feel like I need it? Let's just, and that's when I just started doing it every month.
So where can you go to get cheaper prices? Wyoming?
Well, yeah, I only know this area. Tennessee, I mean, that's right, I've heard that. Yeah,
We're also seeing some of the sellers getting a little more motivated. So we talked about how days on market was really variable. And so some stuff isn't selling. So when we're looking at things right now, we're looking at things that have higher days on market. Sellers aren't necessarily ready to just take a really lowball offer. You know, so we're still kind of, the market's still kind of doing some weird things, and this is just where we are right now. But I mean, that initial slide, so the single family cap rate difference, a large percentage of that lowered expectation was the long vacancy rate. That was $7,000 of unexpected missed rent.
yeah.
And so this next year, that one will look a little better. So the other thing that we're seeing is people are buying. When we get calls from out-of-state investors wanting to buy in Idaho, the first question I ask them before I spend a lot of time going this deeply into formas is, why are you choosing Idaho? Because if you're looking for the best returns in the nation, that's not where we're at. But you're moving here and maybe you want a rental where you live. Or maybe your first house is going to be your first rental in Idaho. And then your second house will be your real house. So whenever you live in a place, you have a reason to invest there, or you may. And it's just about taking advantage of the opportunities that the market currently has, or choosing not to take advantage of the opportunities that this market currently has. But those opportunities shift and we follow them. We went to the single families, and this year, well, that deal kind of stunk. But next year, to Dave's point, it's gonna be better because we're gonna cut $7,000 in vacancy costs because we're gonna re-rent it. And so that difference between projected and actual is gonna shrink an awful lot. If rents go back up, or if the 4-bedroom allows us to squeeze 4 families into that 4-bedroom, well, then if we can get our 2,800, which we wanted, instead of the 2,300, which we got when they all came on at once, those numbers will get better.
And we did get another 100 a month,
Mhm.
that just recently. And I walked the unit and we have a great tenant and the place looks great, so.
And it's new, so they're taking good care of it. They
Yep.
know any damage is theirs.
Mountain Home might be a place to look too, I don't know, for sure, but. You've got the base there and you can't turnover, but you know, you always have the base there. And people are moving to Mountain Home, I understand.
I kind of browsed Mountain Home and even down to Twin Falls and the prices for that was cheap.
Yeah, I believe that Twin
No.
Falls, I can't believe Mountain Home, but okay. I mean, I wouldn't wanna be at Mountain Home because, you know, if they pull the base, what's that gonna do? I don't know.
You
I really
mentioned,
think,
4 families in your 4-bedroom?
Yeah,
No,
what?
we don't have 4 families in there, but we did talk earlier about consolidating households. So that'll,
Oh, yeah, we don't have
That was
4
just an
families in
example.
there.
no.
That's why,
I'm so sorry. 28 people. But I do, look, on the single family for real, you are seeing a lot more roommate situations. You're seeing a lot more people in those. And so that's the other thing, you gotta look at that, the parking. Because, and especially when you get in the higher bedroom counts, there is a lot of roommate situations. And guess what? They all have cars. And so if you've got a 4-bedroom and there's 8 of them, there's gonna be 8 cars, if not more.
these Broadview townhomes off Milwaukee, is that the ones that you said?
Yeah. Yeah. Yep.
Nice to next year.
Marcus, we have multiple families there, we haven't damaged.
Yeah.
Okay.
Okay, so obstacles, low inventory went over, closed management. You know, that's another thing you gotta be okay with. A lot of these new fourplex developments have closed management. If you don't like the property manager, guess what? That's not gonna be any fun. And then, like I said, the 45 days to identify the replacement property is problematic. So consider reverse exchange. It's where you purchase the property first. Which, you know, that's the hard part, right? I mean, you know what your relinquished property is, it's your own property. So you find the new property, you buy it. You have 45 days to identify the relinquished property, well, that's pretty easy, because I already own it. So that there's no stress on that. And then 6 months to close it, well, and I know in this market, I'm gonna get it sold, so it's no big deal. But it gets complicated, and so I just have some disclaimers, you know, you're gonna wanna discuss all of this with the 1031 accommodator, your CPA and your attorney. Make sure you get all your percentages right. Equal or greater debt service. If you have a bunch of cash, you can replace debt service with your own cash. And then there's another thing I did, like the last exchange I did was Sandalwood. Down the street from you. I bought this place on Sandalwood, fourplex. I call it, and I spent, when I bought it, I spent $30,000 just cleaning it up, siding, windows, all that. It's like, I had the diamond in the rough. I'm like, kill it. And then the maintenance just kept coming and kept coming and kept coming. I'm like, well, this thing's sucking pond water. Sold it for like, I don't remember now, but the delta between that and the brand new property that I bought was minimal. So I'm like, out with the, I mean, so this scenario back then worked. Sold that sucker and I got into a brand new one. And it's just been like really good.
I think I bought one of my sandals for you.
Yeah. Man, I was like glad to get rid of that. No, I'm just. No.
That's about, I have 2 fourplexes there on Sandalwood.
Okay,
And, I've been thinking about, that there's minimal sidewalks, but they're really bad.
so I did sell you my sandal.
Oh.
I did.
really?
Okay,
I have 1364 and 1478.
yep, that's it.
Okay,
That's the one I got rid of and went in brand new. Yep,
so.
it's all coming back to me now.
Well, I've done okay, so. I'm
Yeah,
not
good.
mad at you. But, I've been thinking, in my.
That's 'cause
property on
Tony
Joyce,
approves it so well.
Well, I did a
Tony
lot.
put so much money into his properties, he can't handle it, so you probably got it.
Yeah, my roofs are good.
Oh,
Yeah,
yeah,
I appreciate that.
yeah, you bet.
But I have also a fourplex on Joyce Street. like
Yeah, yeah.
you.
Yeah, I sold that one too.
Really?
Yeah.
Didn't know that.
Yeah.
So recently I put in some landscaping, some nice bushes and,
Yeah.
flowers and stuff. And then I've been thinking on the sandalwood to replace those sidewalks for like $3,500 and put in a little bit of landscaping. Well, the other buildings around me aren't great.
Right.
And so is it a waste of my money to do that? I mean, I'm not talking a whole lot of money, some
Yeah.
bushes and,
Well, look, if you drive by it every day and you look at it and you just are discussing with your own property, I'd probably just do it so that you're not disgusted.
yeah,
But is it gonna equate to more rent?
it's not gonna get me, I don't expect.
It's
more
gonna
money.
probably make it more rentable. I mean, so it's gonna rent quicker. I mean, when it looks better, they're gonna rent quicker, but on that street. Cause you got some that just, they haven't done anything.
Right. I can't wait to see what they do with the one that burned down that they're having
Oh, I
to
didn't know about that.
rebuild.
Thank God I wasn't around. I hate it when I get those calls and they burn down. Just ruins your day. So, did I answer your question?
Yes.
Okay.
thank you.
Yeah,
That's kind of what I thought. I just wanted it to look nice. I don't expect more rent.
Yeah.
well, maybe it's part of, keeping your tenant, like doing those little things, because the one on Joyce, the property on
Yeah.
Joyce. She has a tenant there that's been there for 5 years, and when she came in and fixed up the landscaping, he said, I really appreciate that, thank you.
Sure.
My tenants on Joyce.
There you go.
Thank
well,
you.
happy tenants stay longer, so,
That's fine.
yeah. Yeah, as long as you're not spending a ton of money,
Yeah.
it's not, you're not adding a bunch of high maintenance, which is increasing your
Right.
yard care expense. Barberries, boxwoods, low maintenance. Okay, I apologize, I've talked too long. There's tricks on the reverse exchange. I'll skip it. If you're gonna do a reverse exchange, you can talk to me and I can tell you some of those tricks. The reverse exchanges cost a lot of money. There's some risk involved that the title companies don't like. And they charge, I mean, back in the day, it wasn't that much more. And the last one, like, I wanna say I paid like $3,500. Which seemed like a lot.
Don't you need a lot more money to do that because you gotta pay for the first property before you have the money
Yep.
for the old?
Yeah, and so we were, yeah, there's funds. So existing cash, if you don't have it, borrow from your retirement, cash out refi, probably not with the current interest rates. Or get a loan. Any other ideas, Ty, on where to gain money so you can go buy that replacement property first?
No, it's hard to even get a loan on the reverse. I mean, I've done it a couple of times, but it's not easy.
You're right.
They're kind of like construction loan where it's a short-term thing. So you sell your first. property.
Yeah, probably. You could probably do something like that. I use existing cash.
Bridge loan or something?
Yeah.
Yeah, you should do it that way.
I used existing cash. I paid all cash, and then my trick on the debt service was I had a title created a deed of trust to one of my other entities, so it all looked good, but was kind of smoke and mirrors, and it all worked out. Okay, well, so we reviewed the performance of newer versus older. I don't know what we all learned there, but it didn't look promising. Single family rentals, performance is declining a little bit. We identified those obstacles. We discussed the reverse exchanges and if I identified sources of funds. I think, what would you do if you were me? And anybody else have any input on this scenario? Yes, sir.
Tony, thanks for the presentation. Very, very interesting, thought provoking, but is it fair to say, kind of, if I were to summarize what you just said?
Good, because she's gonna ask me to summarize it and I'll refer to you.
Nice to have new, if you can get it.
Yeah, right?
It's less maintenance cost and so on,
Yeah,
but it's driven by interest rate.
yeah,
And if you have a low interest rate, 4.5, you want to trade that for 8%.
correct.
Is that fair?
Yes, sir. You did a very good job at getting right to it.
I will add, I think there's creative financing opportunities out in the market right now that you could really make close. Or they're going to do without the rates being high, enough. People will need to
Like what?
Ah,
have somebody carry
done?
a second mortgage at no payments for 2 years. Deal with your tax loss.
doesn't that assume that the market's gonna slow down more and the sellers are gonna have to do those types of?
Yeah, it does. I think with high rates, though, it is slowing down. And the influx of people from out of state that are making major purchases it's slowed down. So I think there's what we can.
Yeah, we're starting to see more and more, seller carries.
Yeah. Still?
I think it's gonna continue to grow. I mean, if they don't need the cash, immediately, and you can come in with 30% down and they carry, their 3.5%, 4%. And then they give a second for that delta. Why wouldn't you do that?
There you go.
Are you seeing a lot of assumable loans?
I don't run into it a lot. It's hard on VA. I mean, they are assumable, but usually the issue is the vet wants to get something else. And they don't get their eligibility back. So if it just means that.
Oh, yeah. Good point. Okay,
What else should Tony do?
get off. Be done.
Ladies and gentlemen, Tony Drost.
I'm off. Good.
No.
I made it.
Okay, what did we hear today? I heard a great summary from Dave. We heard Tony Drost from Swope Investment Properties, founder of the Boise Investment Properties team, which is comprised of himself, myself, and Leslie Halverson over here. And he took his own portfolio as a case study and looked at, can he get out with the old and in with the new to cut time, to consolidate taxes, and to save on maintenance, which is getting more and more expensive. And as Dave put it very simply, newer is nicer, but right now that decision is driven a lot by interest rate. And when you look at interest rate, that is really the burden on that decision.
Yeah. And he figured that out really quick, and I had to do a spreadsheet. And I went, why isn't this working? And then I went, oh.
So you can pay cash. You can get creative financing, as Alan suggested, go for owner carries. Sellers, if you were willing to carry, you may be able to get a little more for your property because of that. Because that's a driving force right now. And you could consider a reverse 1031 exchange, where you've got more time to find your replacement property, and you can really pound the pavement looking for it, get the right property. In the meantime, you might pre-inspect your property, get it ready to go, make sure it's all polished, find the replacement, then sell your property.
What is a reverse? What is,
Same process that you went through on your exchanges. You did exchanges, right?
no.
Okay, well, disregard that.
Okay.
So it's the same process, just reverse. So instead of selling your relinquished property and then doing an exchange into your replacement property, you identify and you buy your replacement property first,
Oh.
and then you sell the relinquished property. Complicated, but it's completely doable.
Much less stressful.
Less, for me it is.
That'd be good for now, right? Because you know you're gonna sell your.
You are, yeah. Heck,
So,
it could be worth more by the time after you bought the replacement property.
So if we follow the numbers, they may suggest taking more time to identify the right deal so you buy right, because it's harder to find those right deals right now. And then also we learn what works today or what worked yesterday may not work today, and what works today may not work tomorrow. So as the market shifts, we're constantly trying to stay on top of it. And that's why we're all here, because that new single family home that was brand new and was supposed to be great, well, because the rents took a dip and the market took a dip, it took longer to rent in the cold season. That difference in cash flow was 33% lower than he was expecting when he did that brand new purchase. But on year 2, it'll look better. And if rents improve, it'll get better again and it'll catch up. So patience is another name of the game. If you're buying in this market, having a little patience to hit your numbers. And you can get there with cash flow eventually. But the older fourplex was at $36,000 a year in cash flow, and the newer one was at $23,000 $3,000 in cash flow with a six-figure difference in price at today's rent rates. So it didn't necessarily mean newer is better.
Is, again, that's a way better summary. Thank you. We should have just, the three of us should have come up here. That's together.
Thank you, AVID Investors, for sitting and checking out that case study and weighing in.
Yeah.
And giving your input and helping us examine it and for being here. And thank you, Tony Drost.
Thank you.